Brokering success demands a battle-ready strategy. TIE TMS equips brokers with the ultimate battle station for conquering a tough market. With TIE, brokers gain access to a comprehensive platform where rate intelligence and quote history coverage on a single screen. Revolutionize the way your brokers perform by giving them a competitive advantage with TIE TMS. For more info, visit tiesoftware.com/battlestation.
Welcome back to another edition of Check Call. Today we are covering the February market update, and we are joined once again by the fan favorite, my favorite, everyone's favorite, David Spencer, the VP of Market Intelligence at Arrive Logistics. Welcome back to the show, David.
Thank you, Mary. Very good to be here.
I am excited. Is this wait, did we do something in January? Is this our first market update of the year?
I think we did something earlier January. I think we did.
We got to get back on our game. Give the people what they want.
This is our year ahead preview.
Exactly. We did make some pretty grandiose statements in our end of the year review, so I'm very excited to see kind of how that plays out here throughout 2024. It's gonna be a good time. All right. Well, jumping into today, February. Let's take a little look, because let's be honest, January and February traditionally are not the best months to haul freight. They're just not. It's not cute. It's just that it's low volumes. But this past January and February seems to be a little higher than traditional. Specifically, we've seen outbound tender rejections hang out around 5%, which is higher than what we saw in November and December of 2023. What's causing these elevated tender rejections? Because typically in January and February it should be down at everyone's accepting everything.
Yeah, and we've certainly seen that over the last week or so. Both the van and reefer tender rejection rates have fallen off those highs. So, I think reefer tender rejection rates peaked out at near 12%, just under 12%. And on the van side of things, they were hovering just over 5%. And now refrigerated is just over 5%. So pretty big fall on the temp control side. And on the van side of things, we're down into the 3s again already. So February is certainly doing February now that we've made it into the back half of the month. But at the beginning of the month, we were certainly seeing the after effects of what was some severe weather throughout the month of January, creating some difficulties and some irregular patterns for shippers. And that just gets capacity out of place to where it needs to be and causes some challenges for shippers. So our view is largely that disruption we saw throughout January, at the end of the month and in early February was entirely weather related. The rise in rates are from where they were pre-holidays have almost completely subsided back down. So we're seeing rate environment very similar to where it was before the holidays. And like I said, February is doing February at this point.
I like that. February is doing February. You can always rely on it to be just a little slow and a little sad, but it's okay, because then the spring comes, everything turns around. I completely forgot that there was at one point in time weather in just about every state in the U.S. at one point in time in January. Most of the Midwest was taken out by a snowstorm. The South got some ice, and that's something that doesn't ever jive well in the South is ice. It's never a good idea.
Yeah, there were several, we call them gut punches, throughout the country that really, really shook things up. And I think in a more vulnerable market, we would have actually have seen that really challenge routing guides from a sustained disruption perspective. But, that just it kind of acted as evidence to two things. One, the fact that we saw weather sensitivity for the first time in 2 years is a sign that we're probably in a more balanced marketplace. But the fact that disruption subsided relatively quickly after that, the weather events occurred, was a good indicator that we're not quite there yet. There's still some ways to go before we get back to equilibrium and we're susceptible to inflation.
That is, that's not exactly what I wanted to hear. I wanted to hear that we had already reached that equilibrium part, but at the same time, you're just the messenger. You can't magically control the freight market, because otherwise, things would be different.
Just calling it how we see it, Mary.
All right. So the you kind of touched on it a little bit, and that is because we saw those elevated spot rates, or not elevated spot rates, elevated tender rejections. That has in turn not necessarily caused spot rates to increase as that relationship typically does. Because normally when rejections increase in a market, the spot rates also increase. But this time the rejections increased and the spot rates honestly didn't at the same level. So is that again because of that excess capacity that still exists in the market, or was it just, the weather got everybody and it was just a matter of getting everything kind of sorted out after the weather had come?
Yeah, I really think it was the weather still. You look at from trough to peak to trough on the van side of things, rates jumped about 25 cents throughout January and into that weather disruption, and all of that increase has completely subsided at this point. On the refrigerator or temp control side of things, that jump from trough to peak to trough back down to where we were pre-holiday was 50 cents. So pretty significant in terms of the volatility there for rates. But yeah, I mean, rates have been in free fall for the better part of 3 to 4 weeks now, and seeing things come back down to the floor post-holiday, post-weather disruption, really to this lull in normal, you look at the annual seasonality cycle, February tends to be one of, if not the biggest lull in demand. And, we're just starting to get everything ratcheted up for import season to start and produce season to start, and get into that summer peak season where we'll get a better feel for where things lie for the rest of the year.
So if you had to make a guess right now, how do you think that how, I don't know if I want like a percentage, or like how much longer do you think we have for this capacity correction? Because we see carriers still leaving the market. We don't see a lot of new authorities coming out. When do you kind of see that capacity correction cresting and, everyone's favorite term, a return to normalcy?
Yeah, it's a great question. And I think I look right to the larger carriers first as I think through the answer to this question, and talking to a few of these larger carriers as of late to get a feel for where are they at with their fleet expansion efforts or growing their fleets. I mean, these larger asset carriers are carriers that have the access to the freight. They have the contractual relationships with these larger enterprise shippers. And largely they're kind of giving me the same message. They're always hiring quality drivers, right? So you're seeing a lot of these owner operators leave the market. That's showing up as revocations of authority. And it's looking like capacity exits. But what we're really seeing is these larger asset carriers really load up on the high quality driver talent. And so I guess just kind of speaking to that regard, right? If you're a good quality driver, there's going to be an opportunity for you in this market no matter what. And that might just mean going to a larger carrier to find that freight. But yeah, we're certainly seeing attrition of carriers and drivers from carriers of all sizes as a result of trucking conditions that we're at, the rate environment we're at. Fuel dipped recently. I know it's something we'll touch on a bit, but fuel prices heading back up, in addition to rates coming back down. Both of those are negative financial impacts to carriers that are living load to load or paycheck to paycheck. And, when you start to see that squeeze on the carriers, we expect to see an acceleration of exits as a result. Finding a floor here certainly isn't ideal for those playing in the spot market, but in the long term, it will lead to better opportunity for those that hang out and make it through.
So you touched on it a little bit. Gas prices dipped and then they went back up. I guess, do you see that, because we're heading into the summer and the spring, spring and then summer. So, those volumes pick back up. Do you see those diesel prices that are rising? Do you see them continue to rise, kind of fall, or do you see them having a significant impact on rates overall, especially as we kind of round out bid season?
You would think from a seasonality perspective that as you get into the warmer months, you'd expect to see increased demand for fuel and the price increases, but fuel has been extremely volatile and hard to predict, so I'm not going to pretend I have that crystal ball. But let's say fuel prices continue to increase, right? I think that if that were the case, you just continue to see that squeeze on carriers, those that are buying it at the pump and at resale prices. And that's going to have an impact on them, especially if they're dealing with spot rates where they're not tied to a dynamic fuel schedule that's going to pay them more as fuel flexes up, right? And so, if anything, that just accelerates this market cycle that we're in. Now, if fuel prices go down, that's a positive to these carriers because then they're making out on it, right? With spot rates are remaining stable, they're getting paid more per mile than they were before. At least more is going into their pocket, I should say, and less is going into the gas tank. So, that's how we view the movements in fuel prices. Collectively, though, from a rate environment perspective, the majority of our freight is contractual and tied to fuel surcharges. So, to a broker like us, a lot of that is just a pass through.
So for those who are going through bid season, because I know it's pretty hectic time for those full truckload pricing people. Is there a pro tip, or do you see something that needs to be accounted for fuel moving forward, whether it's kind of educating your shippers that, hey, if you do a year-long, 6-month, 3-month bid, this is what you kind of need to account for your fuel. Because I know that the broker doesn't necessarily always, they don't always mess with fuel. It's more of, like you said, a pass-through cost, but still that education to the shipper is still one of the more important parts. So do you really see fuel playing a big role in kind of rounding out bid season or pricing out bids, or do you see it more of like a opportunity to educate shippers on what could happen if fuel continues to increase?
Yeah, largely my perspective on this, and I think many's perspective on this, is that fuel is just something that we can't control, right? It's sort of out of the realm of our industry to control that, and it's a cost that we all have to deal with. On the shipper side, if you're seeing increased fuel costs, you might look to squeeze in other areas to offset that as it relates to your overall budget. On the carrier side of things, if you're seeing increased fuel costs, you're going to ask for a little bit more money, and vice versa, right? And so, I think most of the participants understand how fuel affects things, and I don't know that it's going to have a big impact on the RFP cycle here, but I do think that shippers are continuing to look for and press for one more bite out of the apple, so to speak, in terms of contract rate declines, given where we're at and what we've seen here in the middle to latter part of Q1. I think the biggest thing to watch is where these line haul rates get set back down to through this early year RFP cycle. The further down contract rates fall as a result of these RFP results, the closer that spot contract gap's going to be, and the more vulnerability we're going to see in the back half of the year.
Do you see more people going for the 3-month bid cycle, the 6-month, or that traditional year-long? Because I know right now, if I'm in a tighter market or where rates aren't as great and I'm a shipper, I'm going to push for that 12-month cycle. But if I'm a carrier and I know that, the back half of the year rates are going to flip, it's going to be more profitable for me, I'm going to push for that 6 months. So do you see one kind of favoring out over the other?
Well, it's certainly conversations we're having right now with shippers that are looking to do annual bid. We're speaking to them about the plausibility of a market disruption in the back half, and just what conversations would look like if we were to see a major disruption, right? So I think it's certainly a conversation you need to have when you're talking about pricing, especially in a broker to shipper relationship, and what the expectation is going to be for continuing to service that shipper through those changes in market conditions. And that's something we don't shy away from. I think that's something that you have to take into account. We've seen a much bigger move to an annual RFP cycle away from those shorter RFP cycles, largely due to that outlook or that prospect for a disruption in the back half of the year. And as a carrier, as a broker, you'd like to push for shorter terms, but in most cases, the shippers are the ones calling the shots here. So you just kind of have to roll with what they're putting out there.
The infamous words, the shippers, you just got to roll with what they want to do. Even if it's a little crazy, you just got to say, okay, we can do it. It's weird, but we can do it.
You don't get as many Carrier of the Year awards for servicing customers as we do without putting them first.
There you go. Look at that. I thought that's a good Arrive plug of, we do it better. We do it the best.
Certainly prioritize service.
All right. So I guess we've danced around it a little bit so there's that kind of perceived idea that the back half of the year will potentially turn and be a little bit more profitable, not anywhere near what we saw in 2020 or 2021, but where carriers can actually run at a continuous profit, which I didn't think that would be like the bare minimum of what I would be asking for, but it is. I guess, do you see, so if the freight market balances out in the back half of the year or here in the coming months as we get closer to summer, do you see that as like a solid thing, or do you see that, if once we hit balance, there's a higher chance for that disruption to come again?
Yeah, my view on this is it comes down to the question is talking about vulnerability to sustain disruption and what's going to facilitate that. That's continued exit of supply from the market and more balance. And I think what we've seen over the last year is relatively stable demand, maybe down a little bit, and capacity that's exited, and that's created better balance. And I think that trend continues is a better balanced marketplace as we move forward. And as a result of that, you'll see upward pressure on rates. Now, will that lead to a sustained disruption? I'm still a believer that we'll need something to shake things up. In addition to just this event of capacity exits, could it be severe weather? Could it be some type of other demand event potentially? It really depends in that scenario. But from a carrier perspective, the longer that rates are down in the gutter, the more that's going to weigh on them. But the more upside that we're going to see on the on the tail end of this.
I mean, just a few disruptions for the back half of the year. That's, typically hurricane season in the south and the southeast, and then, tornado season in the Midwest, and then toss in a casual presidential election, and then, ever-growing uncertainty with certain other geopolitical events. I mean, what kind of disruptions could we be looking at?
There's so many opportunities for this market to receive kind of that, to get flanked, so to speak, by one of these events that they just can't really see coming necessarily, right? And so, we call these black swan events or whatever it may be. We're preparing for them more so now than ever because we're looking at the other factors, fundamentals in the market that we'd want to see in order for the market to be susceptible to these, like that contract to spot gap, right? And continued exiting of capacity. Where's that tender rejection index getting to? Every time the tender rejection on the van side has gotten to 8 to 10%, we see a disrupted spot market, right? So in February or in January and February, we saw rejections get up to 5%. That's meaningful, not meaningful enough for disruption. But if we see it later in the year jump up to 10%, we certainly know we're on the verge. We might already be there.
I like that. It's meaningful, but not quite meaningful enough. It's kind of that it hits that point where you're like, oh, I actually should pay attention to this and watch it and keep an eye on it, because there might be certain regional markets that are at that over 8 to 10%. So if I'm a broker sitting there trying to price everything out, knowing where my hot spots are is going to be extremely helpful in kind of, not overpaying for freight or simultaneously not underpaying and struggling to get it covered. So I think that, keeping that national average is kind of underrated sometimes in what it can show.
Yeah, I mean, I would equate what we've seen as of late to signs of fragility in the market that we haven't seen in a period of time. And those signs of fragility are certainly worth watching.
So speaking of fragility, let's get out that crystal ball and let's look and see what is one of the telltale signs that the market might be flipping, and that we've turned into that stronger spot rate and stronger demand. Obviously, we didn't necessarily see it in February, but just looking forward, if I'm sitting there and I'm logging in for the day, what are some things I need to check that might be worth taking a note of to watch long term?
Yeah, I love that transition, by the way. Very smooth. Yeah, as far as what leading indicators to look at, I mentioned already the National Tender Reject Index. I think once you cross that 8 to 10 threshold and you see it get to that level, that's meaningful. When you start seeing 10% rejection rate, that's certainly a red flag. Also have to look at the conditions of the current market environment. What are the things that we're seeing trending, right? You could look at the expectation is that we're going to see increased market share shifting back to the West Coast from an import perspective as a result of what's going on in the Panama Canal and the Red Sea. And restocking efforts here to align with continued strength in consumer spending. So West Coast volumes start to pick up in Q2. At some point, that will begin to overwhelm, the railroads coming out of the West Coast and overflow to over-the-road transportation. My guess is that you're going to start to see sensitivity outbound California be the leading indicator for what's going to occur throughout the rest of the marketplace. So I'm certainly going to be watching Southern California and what's going on with import demand there, because I think that would be a reasonable place to see first signs of a demand surge cause some shakeup or some disruption or some increased rejection rates and spot rates. So watch Southern California, watch tender reject index, and then watch for that spot to contract gap closing here as we see new contract rates going live.
That being said, we are running out of time, and it is time once again for us to ask David Spencer yet another unhinged question. Are you ready?
I'm ready.
Would you rather have the ability to talk to animals or speak all foreign languages?
This is a really tough one. I'm love some animals. Okay, I would totally dig just going and hanging out with the elephants or the cheetahs or something like that and making some conversation. But I love to travel and I love foreign cultures and getting to know people from different walks of life and being able to speak whatever language I wanted to on demand. I mean, that just sounds like a superpower I want. So I'm going to go with that.
I also like that question, but this is also probably one of the hardest questions that I've asked someone, because I always like to think what would I answer? And it is a very hard decision, because if I could talk to my dog and have her understand me every day, that would be amazing. But also if, you go to a shelter and then you have to listen to all these other dogs talk about their very sad stories, I can't handle that. But I very much like the all foreign languages, because that would come in handy all the time, literally all the time.
Totally.
All right. So if anyone wants to, reach out, borrow your crystal ball for a day, where can they find you outside the show?
Yeah, visit our website at arrivelogistics.com. All of the insights that we publish, our shipper market update, our carrier market outlook. We have a quarterly Canada shipper market update that we're putting out now, as well as on a quarterly basis forecasting, the spot rate environment for dry van and refrigerated equipment. So if you want to dig in any of that, you can find it all for free on our website. Also LinkedIn. Yeah, you can reach out to me and comment on all of our wonderful content, or check out our regular occurrence here on Check Call with you, Meredith.
I absolutely dig it. And the best part is, as David mentioned, the Arrive Insights are 100% for free, which is mind-blowing that it's for free. So thank you, Arrive, for giving this amazing tool to everyone. Once again, for free.
Thank you so much for having me today, Mary. It's been a pleasure.
Thanks for joining us. You can find Check Call the Podcast anywhere you get your podcasts, like Apple Podcasts and Spotify. Don't forget to check out all the other incredible FreightWaves podcasts and subscribe to the newsletter on freightwaves.com/checkcall. See you on the internet.